Here on the Buy-to-Let Show, we've been talking about why some people are successful at buy-to-let while others fail. Let's hear more about this now with my guests. We've got Cheryl George from Chase de Vere, Christina Dimitrov from Direct Line, and Vanessa Warwick from Property Tribes. Hello, everyone. So my first question is to you, Cheryl. You're an independent financial advisor, so you're not a property expert as such. So what are the risks of a buy-to-let investor not speaking to you before they buy a property?
What they're doing by focusing on one area, they're risking a lack of diversification. What we do when we're looking at any investments, we look at the whole financial plan. So it's really important to make sure you take all your financial circumstances, what your goals and aspirations are for the future. By focusing on buy-to-let only, you are actually just focusing on one area.
And I guess what you're also doing is, as an independent financial advisor, your job, you know all of the costs that I've got coming up.
Absolutely.
That I might not know about.
Absolutely.
So unless they kind of come and talk to you first, I might invest not really understanding what my goals are properly.
Yeah, I mean, the impacts of that is, if you're just focusing on that one area, you've got to think about the risks in terms of taxation. So you're not really looking at the most tax efficient way to invest. And also, you know, from a liquidity perspective, if you put in all your eggs into one basket, you haven't really got liquidity, and all your investment are focused on one area, so you're relying on property prices doing really, really well. And there are so many other things that's available. So we look at the whole financial plan, we look at diversification, which is really key, and we try and make sure that you've got a balance of assets so that you're not focused on one area or relying on one particular asset class to do well.
Yeah, and you mentioned the tax side. What I don't think people quite realise is that by adding a buy-to-let to their existing wealth, you might actually cause yourself some tax problems, which you might not be aware of, and that's key, isn't it?
Absolutely. That's the biggest risk. I mean, there's tax on exit on a buy-to-let, so when you're looking at your exit strategy, you really got to consider up front the timing that you're going to be in, because when you are ready to exit, you'll be paying tax. Not only will you be paying tax throughout, but it's the exit strategy as well. So there's a lot to consider. And buy-to-let is really expensive to enter into, and it is not the most costly to manage throughout. So there are other types of investments that will give you far more tax efficiency, far better spread, easier to access and cheaper to maintain.
And it's just about, so you're not going to force them into doing something else if they want to do buy-to-let. It's just making sure that they've got a well-balanced investment portfolio.
I mean, we are looking at buy-to-let as one. So our clients will have buy-to-let as part of their part of their portfolio. So we're making sure that they've got balance to their portfolio by diversifying them. So we look at their buy-to-let alongside everything else.
OK, so Vanessa, we've been chatting about taxation. Lots of, certainly on your forum, lots of questions.
Yeah.
Is it still possible to make money from buy-to-let, or are we just taxed out?
I think it is still possible to make money from buy-to-let, but the game has changed dramatically, and anybody that enters into it now is going to have to take a much more professional approach. Clearly, there are massive threats to landlords. The biggest, in my opinion, is Section 24, which kicks in from April this year.
And just to explain, that affects the mortgage interest relief that you get.
Yes, you can no longer claim it against your tax. It's going to be phased in over 4 years.
So typically that's if you're a higher rate taxpayer, but some lower rate taxpayers might be pushed into the higher rate.
That's correct, and it mainly affects the more highly leveraged sole trader landlords. So it's not going to affect every landlord, but it is a massive consideration. So moving forwards, if you're going to invest in buy-to-let in 2017, you need to take professional advice, and it may be that you need to go the incorporated route and set up a limited company and invest through that. The other sort of threat to landlords, or the challenge, is the advent of the PRA, which means that landlords are going to have to put in potentially much bigger deposits.
25 is the minimum now, but I think most landlords, it's about 50-50 they tend to do.
Well, sort of in the previous years, a lot of landlords have, it's actually been advantageous to really leverage up. Some even, in the 2000s was up to 85% loan to value. It's dropped to 75% in recent years. But now, because of the introduction of new stricter lending criteria, the way that mortgages are given. I suppose it just means that there's a lot more stress tests in terms of how lenders look at buy-to-let loans, and typically it is going to mean perhaps a 35, even 45% deposit, depending on where you are in the country and what kind of rental yields are there. So, these are major threats to landlords, and I think that the landlord of the future will be far more professional, probably investing through a limited company structure, and they will need to treat it far more as a business.
Yeah, it's not about going and buying any property, keeping your fingers crossed and hoping it will make you a little bit of money. You've got to do all the legwork beforehand.
Absolutely, more than ever.
And a question to all of you really, to help with that research, is if you're talking to someone who's new to buy-to-let, what is the one tip that you would give them? Christina, what's your tip?
For us, a big one, lack of maintenance. I think it's got
Huge.
so many negative effects you may not be aware of if you choose to cut corners and ignore certain issues that look small. It may reduce your rental income, it may reduce your capital growth. Your tenants, who may be good tenants, may choose to move out because they know there is value for money elsewhere.
So increase your voids, increase the amount of time it's empty.
That's right, but also emergency fixes may be something that you have to face because, say, you've ignored a leak that your tenant informed you about, and then all of a sudden the pipe bursts and you've got the massive damage. Call-out fees are massive. But the one thing you also have to always be aware of, there's certain things that you have to do in a property that means obliging the law. You need to maintain certain carbon monoxide alarms, smoke alarms. They need to be checked and tested every now and again. That's your legal duty, so you might be breaking the law if you ignore that. The other thing now is, from an insurance perspective, it's important that when you make a claim, your insurer will assess if your duty of maintenance has been fulfilled. So what they do is they look at the damage and they say, well, did actually the landlord and a lack of maintenance and some neglect even cause that incident or even exacerbate that incident? So you've got an all-around duty to take care of what's yours.
Yeah, okay, I think that makes
It could
perfect
be actually
sense.
a sort of breach of the terms and condition of your mortgage as well, if you
Absolutely.
don't maintain your property. And I just don't understand why people don't. It's your greatest asset. You want to make sure that it's maintained properly, that you're achieving the highest rent, the highest occupancy. It's just a false economy to let an investment property fall into disrepair. Not to mention, as we've been saying, all the legal aspects of it. And there are very, very hefty fines for landlords that have disrepair issues.
Yeah. And I mean, Vanessa, you could probably rattle off 100 tips for buy-to-let investors with your vast experience, but what's the big one for you, for somebody new to it?
Well, I've been a landlord for 15 years now, and the biggest single tip I say to anybody is become an expert in due diligence. If you do your research at the beginning and fully investigate every aspect of what you're getting involved with, not only the property, but the lettings agent you're potentially going to work with.
Check them out, yeah.
Massive due diligence on your tenant. The best way to never experience a bad tenant is never to let one step over the threshold of your property in the first place. Just do intense due diligence on everything, because if you put that effort in at the beginning, it vastly minimises your risk, and it reduces all that heartache and financial loss that can occur if you make an unwise decision. So really do intense due diligence on anything and everybody that you're going to have any kind of commercial relationship with, and it will save a lot of heartache and financial loss.
Great tips. Thanks very much, everybody. So that's it for now from the Buy-to-Let Show. Many thanks to my guests, and thanks to you for joining me. Don't forget you can see all of our programmes online to find out everything you need to know about buy-to-let. See you next time. Here on the Buy-to-Let Show, we aim to bring you all the information you need to run a successful buy-to-let. You can find more advice and help by following these links. And you can download our special ebook, which goes with the programme.